Hey guys, Daniel here with Value Investing with Daniel. Thanks for tuning into this video. The theme of this video is evaluation, not valuation. What do I mean? You should be spending the majority of your time as an investor evaluating the company, not valuating it. Meaning you're not trying to calculate an intrinsic value of the company until basically the very end. Once you determine it's a great company, doesn't have a lot of debt, has wonderful management, has a lot of good growth prospects. At the end, once you conclude that it's a good company or a great company with a lot of room for growth, one run by excellent managers, then you can say, okay, how much is it worth approximately and what's it selling for? And am I getting a decent margin of safety in this purchase? You do not need to spend ridiculous amounts of time, hours building spreadsheets to determine the value of the company. It's largely a waste of time because you can't come up with a precise figure or even a rough range. You know, if you find a great company that, has excellent management, whose growth prospects are tremendous, who's producing a good or service that's not going to be irrelevant, with high returns on invested capital and high returns on equity and so forth. And these numbers are stable and growing, and it has a dominant competitive advantage of some sort. The number of companies that meet that criteria are probably less than 10 in the entire universe of investments, maybe 20. Personally, I'm only looking at Canadian and United States markets. And I can tell you that within those two markets, you might be able to find like 10 or 20 companies at most that meet all those criteria. So now when it comes down to valuation, I mean, you have a company with excellent management that's growing at, 15 or 16% per year with a lot of room for growth that returns, extremely high levels on its capital. What is there to value? If it's trading at 20 times earnings, it's probably a decent price. If it's trading at 15, it's probably an excellent price. My point is that, you just got to look roughly at the earnings per share, what they're growing at, and compare that to the multiple. As long as those earnings are roughly, consistent with the previous trajectory of earnings and free cash flow, there's not much that you need to evaluate in that sense. So don't spend tremendous amounts of time and energy trying to calculate some sort of intrinsic value. It's supposed to be a rough approximation. And all you need to determine if, based on the current sustainable growth rate and the management and all these other factors, if it's a fair price. And only you are going to ultimately know that based off of your own experiences. But the point of this video is really evaluation is key, meaning you got to evaluate the management. You got to evaluate the future prospects. You got to evaluate the returns on capital, returns on equity, all these different numbers, the profit margins, the product lineup, what the future of the company is. That should be the majority of your time, not valuation. Okay, valuation is not hard. You don't need Excel spreadsheets. You don't need complicated models or this or that. You just need a good sense of what the future of the business is and compare that to the current price. Valuation takes less than 5 seconds. Literally, you need a couple of numbers, but you need to have a good understanding of what those numbers mean, and you need to evaluate the company so you can get those numbers. Once you have them, to evaluate the company is very easy. 3 seconds. I can tell you if it's a fair price or not. But to evaluate the company will take 3, 4, 5 days, of reading annual reports and so forth to determine if it's a good company. So focus on evaluating the company, seeing if it's good, seeing what its future long-term prospects are, seeing what the management is doing, all these different things. Evaluation. Once you determine it's a good company or a great company, which, like I say, maybe only 10 or 20 companies in the entire universe of stocks in the United States and Canada meet those criteria, then we can talk about valuation and see if it's a fair price. And generally speaking, if it's trading at a PE multiple and it's a great company with great long-term future prospects and growth, if it's trading less than 20 or 25, it's probably a good buy. But if it's trading at more than that, then it becomes a little bit more iffy. But you got to also look at interest rates and all these other factors to determine that. But there's no complicated model of intrinsic value that you need to run or some secret formula or anything really like that. It's just simply valuation is like a 3-second process but it's going to be determined on the evaluation that you've done for the past, many hours looking at this company and looking at its future prospects. So I hope that was informative. Please like and please subscribe. Spend time on evaluation, not valuation. That's the key. Thanks.